Southeast Radio's Business Matters with Carl Fitzpatrick.
Well, when my next guest was just 15, iconic Irish businessman Dermot Desmond set him on his way to an accomplished career in finance. A former senior executive with Davy, Stephen Felle has recently established a wealth management and financial advisory firm called Fordel. Stephen joins me now to tell us about what sets the firm apart from its competitors and why Irish consumers need to consider inflation-beating investments such as stocks, shares and bonds. Stephen, we'll be finding out how Fordel is shaking up the wealth management market in Ireland. But first, I know that on the day of your father's funeral, a conversation with Dermot Desmond launched your finance career. What did he say to you?
Well, you're bringing me back a long way, Carl. I was 15 and it was summer 1990. So my father had died tragically quite young. He was 41 years of age and he worked in finance. He was a bond dealer in Bank of Ireland back in the late 1980s and was a friend and contemporary of Dermot Desmond through work, and Dermot was attending his funeral. So that's the background as to how he came to be there. Now, Dermot Desmond since then has gone on to be a business colossus in Irish terms. Back then he was probably 40 or 41 years of age, just beginning to build his business and build his profile. We were actually walking out of the church after the funeral, and Dermot, in a quite fatherly way, had a hand over my shoulder and asked me what I wanted to be when I grew up. And Dermot was always very dapper in terms of how he looked, and he'd arrived at the funeral that day in a beautiful silver Daimler, and I was very impressed by everything that I observed. So I told him I thought I'd like to be a stockbroker, and he told me to come in. That was August 1990. He told me to come in to NCB, which at the time was on Lower Mount Street, and I could have some work experience in the Halloween holidays. So I went in first in October 1990, and every school holiday and every college holiday from then until I started full-time in that firm was spent in NCB.
And I do believe as well, Stephen, that Dermot was a great mentor to you over the years since then.
We've kept in touch. I see Dermot from time to time at various events. I've been lucky enough when I've asked to have a coffee with him or have a sandwich with him if he's in Dublin, just to ask his advice on certain things. And if I think back to when I was setting up the business that is now Fordel, going back 5 years ago, at the time, in terms of giving advice and giving time and giving guidance, Dermot was very generous at that time when I really needed somebody objective and somebody who'd done it before and done it with great success to give me some kind of mentoring.
So what advice did he give you?
A couple of nuggets to take out. Never be afraid to hire people that are brighter or better or more ambitious than you, because it's only through doing that you'll firstly, you'll continue to learn and continue to challenge yourself. And secondly, you'll be able to bring complementary skill sets and more brilliant minds into helping you execute on your plans.
And talk to us about your time at Davy and your rise to senior executive level within that organisation.
I joined Davy in 2004, Carl, originally as regional director in their Cork office. So if we think back, that's now over 20 years ago now. So we were just reaching the nexus of the Celtic Tiger. Economy was growing hugely. We had what turned out to be a great bubble in stock markets, debt markets, and indeed property. But my role during that Celtic Tiger era was initially, as I say, to set up a regional office for Munster and Cork, and then I grew that over time. So we built a regional network across the UK with offices in Galway, in Belfast and in London.
And what prompted you to leave the security of Davy behind to pursue your entrepreneurial ambitions?
I spent 15 years, just over 15 years at Davy, Carl, and I suppose I'd had the heady heights of the Celtic Tiger boom. I joined the board of Davy in 2012, just as we were coming out of the doldrums of the economic crash, and was part of the team that helped reshape that business and really become the go-to wealth management, independent wealth management company in Ireland. And a hugely steep learning curve, a very hard-working, ambitious environment, worked with some really, really bright people. And perhaps, you asked about what made me leave Davy. Actually, perhaps I'd never have left Davy, except that I always had an ambition to run my own financial services firm. And that, at a point in my career, may well have been Davy. Things happen in large organisations. In late 2018, the Davy board decided to bring in Bernard Byrne, who was then CEO of AIB, which is the biggest bank in the country. And he joined us as deputy CEO and effectively CEO in waiting, as it subsequently transpired. That was a reflection moment for me. I was in my early 40s. You look at the CEO of the biggest bank in the country coming into a firm that's a tenth of its size as number two. And while I thought it was a great appointment for Davy and its shareholders, it was a kind of a wake-up call for me that if I ever was to run my own business and if I was to ever back myself, it would probably need to be by establishing something on my own. And that's really what led me to leaving the organisation.
So how does Fordel differ from other wealth management and financial advice offerings which exist in the market today?
So Fordel is 5 years old now, although we've recently gone through an expansion and a rebrand. So we established a company called Argo in January 2020, which was exclusively focused on what are called ultra-high net worth investors in Ireland. So typically individuals and families with 50 million upwards in investable assets. And over a 5-year period, we built that into a relatively niche segment. We built that into a business advising on about €2 billion of assets for some of the wealthiest people in the country. But if I go back to when I was at Davy and the reasons I left there, I always had an ambition to bring a group of people together to set up a challenger wealth manager, which would become a scale player in the Irish marketplace rather than the niche one we had created in Argo. So that's a bit of background to what brought us to establishing Fordel. We see a huge gap in the marketplace for an independently owned player exclusively focused on business owners, entrepreneurs, high-earning professionals and wealthy retirees with €1 million and upwards to invest. There are a myriad of companies out there servicing everybody from the regular saver with €50 a month to the wealthy investor with €5 or €6 million on their pension. And that's each of those pots is as important to the owner, irrespective of whether they're 50 grand or whether they're €5 million. But we just see the gap and we see a dearth of high quality, high touch financial advice and wealth management in that 1 million and upwards marketplace.
So how are you going to acquire these clients?
In a number of ways, by demonstrating to our target clients and the prospective clients that we're meeting with that we're different because we're independent thinking. We're not shackled by being owned by a bank or a life company. We are what we call whole of market. So we deal with all of the investment providers and product providers in the marketplace. And it means we're free and independent to recommend whatever the best solution might be for a client. So independence is a key pillar. I spoke, Carl, about our exclusive focus on high net worth clients. So because we have a minimum investment threshold of €1 million, our clients are going to benefit from direct access to more senior advisors and getting really high touch bespoke service. And this was the third thing that sets us apart and we hope helps attract clients to Fordel is we have a huge mantra and a huge focus around transparency and value. So we're offering financial planning, investment management, wealth management at 1% per annum annually on average. And this was just to put some context on it. We've sized the rest of the industry. We've sized those who are competitors in our addressable market, and the industry is substantially above that on average. And people who have €1 million pensions or people who have €1 million savings plans will be surprised to find that they're often paying anywhere between 1.5% and 2.5% per annum. I suppose in terms of being very much around delivering value and having very much a transparent culture within the organisation, we think that will help us attract clients and is certainly resonating with our target audience since we launched the business 4 months ago.
And in terms of funding the business, Stephen, have you received external investment for this venture?
We have, Carl. Yeah, we decided that if we're to launch a scale wealth management business that is going to compete with some very deep-pocketed, internationally owned players, as I mentioned, Irish Life owns a number of businesses in the investment and wealth space. Bank of Ireland now owns Davy and New Ireland. AIB owns Goodbody. We obviously don't have the financial might of some of those examples that I've given, and we didn't have it if we remained self-funding. So we took a substantial amount of external capital from a group of Irish high net worth individuals, very much playing to using Irish entrepreneurs and Irish capital to help us build a firm for Irish business people.
Of course, Fordel recently published a report entitled Wealth of the Nation. On the basis of this report, how would you describe Ireland's current level of wealth?
Well, on paper, the wealth of Ireland has increased dramatically from the bottom of the economic cycle back in 2010 or 11, or even over the last 10 years, where we've seen household wealth double. And the average household in Ireland now has wealth of €665,000, and approximately 20% of households are millionaires on paper. So they're the high level numbers. When you go beneath it, and it'll be no surprise to you or to your listeners, a huge amount of that wealth is tied up in bricks and mortar and the homes in which people live, and is heavily correlated to the recovery we've had in house prices in Ireland post-crash. So people may, on paper, be substantially wealthier than they were 10 or 12 years ago, but actually monetizing that or feeling wealthy is a very different is a very different experience, especially given how inflation and how the cost of living has increased so much over the last 10 years.
And at the end of 2024, there was €180 billion sitting in the current accounts and short-term deposit accounts of Irish consumers, earning little to no interest. Essentially, as a country, are we underutilising conventional inflation-beating investments such as stocks, shares and bonds?
Absolutely, Carl. And your listeners might think that I would say that because I'm running a wealth management company, and we're very much focused on helping people build long-term investment portfolios. But even if we look at how we rank on an international basis or against other developed economies, we go back to the report that we recently published on the wealth of Ireland as a nation. There's approximately 5.5% of household wealth is invested in stocks and shares, which are classic inflation-beating investments. Comparably, the levels in the United States are at least twice that, and even if we look to our nearest neighbour in the United Kingdom, are probably 50 or 60% above that. A lot of that is cultural, and this is probably only the second time in the state's history that we have amassed significant wealth to the extent that you've referenced. But also, we don't have some of the same incentives, state incentives or tax-efficient schemes that our aforementioned neighbours might have had. So it's not a criticism. We've after the malaise of 2007 and 8, where it took us a long time to recover from the crash. It's only now that we can kind of look and say we've amassed a very significant and firmly grounded household wealth as a nation. It remains very skewed in property, and to your point, 180 billion of it sitting in cash deposits, which are earning little or no interest.
And talk to us about how people are taxed on these investments, including that deemed tax charge.
There's been quite a bit of coverage around the expected change to fund exit tax. So fund exit tax is a 41% tax charge that is levied on the income and the gains on certain fund type investments after 8 years. So a lot of terminology, a lot of complexity in what I've just said. But what at the nub of it, it means that it is a disincentive to save for the very long term using fund structures, which means that after 8 years, whether or not you want to sell your investments, you're effectively required or deemed, to your word, to give 41% of the gains and the income to the taxman. If you're 40 years of age and your target retirement age is 65 or 66, there should be an incentive for you to continuously contribute to an investment fund or a medium risk structure, which means that by the time you reach 65 or 66 years of age, you have a significant enough pot that you can live very well for the rest of your life, and that you're not a burden on the state in terms of social welfare, in terms of being or having a pension shortfall. So that's a long-winded way of giving some background to why the fund industry and the financial advisory industry in Ireland would welcome a change to that deemed distribution, and indeed a reduction in the 41% tax rate, which funds attract, to something like the 33% tax rate, which capital gains tax are at. It should, and I very firmly believe would, create more of a long-term savings and long-term wealth accretion culture without any costs or any great costs to the state.
And is there also an opportunity to use these large deposits to support start-up businesses and SMEs?
There is, Carl. I suppose it is worth pointing out that we do have incentives in place to promote and to invest in Irish startups and growth companies. We have the EIIS, the Enterprise Investment Scheme, but again, some of the rules around that and the ways in which PAYE earners can access it are very cumbersome, and actually, I'd argue, too administrative and quite prohibitive. If we look, and again, just looking to comparable neighbours, UK mightn't be part of the EU anymore, but it's still a very comparable economy in terms of how people are remunerated, how industry grows, how enterprises spawn the indigenous economy. In the UK, a taxpayer can invest in what are called venture capital trusts, which give them a tax break on their investment, which somewhat de-risks the downside of the investment, and the gains and the income in the companies in which they invest roll up on a gross basis for the period that they're invested. These will be typically higher risk startup and mid-stage companies, but what it's encouraging the deposit holders and the taxpayers to do is take some savings and take some of the money that they have on deposit, create a tax incentive for it to go into mid-stage and startup companies, but it actually just creates a greater capital pool for which ambitious companies can draw from, which unfortunately we don't have to the same degree in Ireland.
Well, if you've just tuned in, that was Stephen Felle from Fordel, and I wish Stephen every success with growing his business.
Southeast Radio's Business Matters with Carl Fitzpatrick.